certainly the inflation report suggests that there's no reason to say that a smaller rate increase than we did last time, right? Because nothing moved in that direction.
This report reflects that inflation is unacceptably high.
Right now, they are hyper-focused, solely focused on inflation. And that is their key objective, getting that price stability.
This is Bloomberg Surveillance, early edition with Francine Lacqua.
Good morning and welcome to Bloomberg Surveillance. This is the early edition. I'm Danny Berger in London, in for Francine. Here's what's coming up on today's program. US CPI scorches at 9.1%. The Treasury curve inverts to levels not seen since 2000. King dollar pummels euro to parity. Jumbo hike in play. Markets see 50-50 chance of historic 100 basis point move as inflation piles pressure on the Fed. Plus, rebound on the ropes. Draft projections show the EU slashing its GDP forecast amid surging prices and energy crisis. Happy Thursday to you. Everything is in play. Those are the words from Bostic after that red-hot nine-handle CPI reading. That had markets repricing, at least in the bond market, 50-50 odds of 100 basis point move. Also follows Bank of Canada taking the plunge, going jumbo times 2, 100 basis point hike from them, of course. European stocks, those moving lower this morning, down 0.5%. The 2s10s curve, this is where we saw a lot of the pressure come in. That sunk to its most negative level since the dot-com boom and bust. A lot of this has to do with the bid to duration on the long end, looking for the safety, that concern about the economy. There was a 30-year auction yesterday. The leftover of that auction was the lowest on record, really just highlighting the demand that was there. Finally, we have the euro dollar. That did sink to parity yesterday after that CPI reading. A little bit above it now. We have a lot of options around the floor of 1-to-1 that's keeping it from sinking further. Of course, we are looking at volatility. Options pricing 1 week out around the ECB meeting. That volatility is at a 4-month high, so concerns are still clear in this market when it comes to the euro. And finally, looking at BTPs in Italy, those yields up by 21 basis points. There's concern about the government. There's a confidence vote. Conte saying he might boycott that. Draghi saying he'll walk out, he'll resign if that does indeed happen. So that tension means that the spread between Italy and Germany, the yields there, that's blowing out again to the most in a month. Let me show you what European stocks are doing as a whole. That Italy story there, the concern there does mean the FTSE MIB, one of the worst performing. That's down 1.5%, a clear underperformer. DAX, not as bad. UK stocks, those are down 0.4%, but still a lot of repricing and grappling with what it means to have the Fed going all out, with the ECB really curtailed by some of the drama occurring in Italy. Well, let's continue with that story. Really, our top story today, the U.S. inflation hitting 9.1% in the year to June. That's another fresh 40-year high. It strengthens the Fed's resolve to stay on its aggressive hiking path and makes another jumbo increase in July pretty much certain. The question now, though, will be, does the central bank raise by 75 or 100 basis points?
This inflation print, it's a problem.
This was a very hot report.
There's no slowdown in inflation here.
Domestic price pressures are still quite strong.
This is going to amp up pressure on policymakers.
This keeps pressure on the Fed to keep going.
It needs to keep moving at a rapid clip.
We still think they go 75 in July.
The Fed probably will go 75 basis points.
It's going to be very difficult to get off 75 basis point hikes.
This morning's report seems to solidify that 75 basis points.
But I think they really ought to be careful here, because this is actually turning.
These rate rises are coming as growth is starting to slow.
They can't respond to slowing growth. We know growth is slowing, but I think they're going to just keep going.
And that's a real concern.
Tightening policy into slowing growth is just not a good combo for risk assets.
They can slow down the pace, but I don't think they're anywhere close to stopping.
Let's add another voice to the conversation. We're joined now by Francesco Sandrini, head of multi-asset strategies at Amundi. Francesco, thanks for joining us. So if it is 100 basis points this month, be it stocks, currencies, bonds, which asset is most vulnerable at this point?
But pretty much all the assets are vulnerable at this point. Some of them have already heavily corrected. If you think about commodities, for example, are discounting recession risk, which is probably quite high, with a minus almost 20% from the peak of late May. I think that a lot has been discounted in terms of pricing on the equity market as well. Probably our reading of the situation is that the equities probably are discounting a little less of this chance of recession than the credit markets. And in particular, high yield markets have been ballooning a little more. giving the impression to us that there is still a leg to go on the equities, especially considering the flows that so far have been quite muted leaving the equity markets.
That's not too dissimilar from what Marko Kolanovic over at JP Morgan saying that credit, it still perhaps has some pricing to go in terms at least of a recession. BlackRock, though, says that they like credit considering that the risk of default is low at this moment. So, Francesco, would you be selling credit? Would you be buying credit, holding neutral? What do you do with that positioning with that outlook in mind?
Of course, we have still this lack of correspondence between the default rates that normally are lagging and what the price activity have been doing, widening the spreads. At margin, I think that the high yield still contains a little more risk, and we probably see the high yield market widening even more. And this is, frankly, something that suggests to us to stay quite cautious on the high yield markets. While I think that at the same time, especially on the investment grade corporate bonds, and especially in US more than in Europe, there is a decent constructive approach. And I think that probably these levels are interesting levels to start accumulating a little of this exposure, because the widening has been probably more pronounced in proportion to risk.
Yeah, interesting. You know, perhaps some of the irony of yesterday's CPI was that at the same time we get that published, we get the beige book, and there are more pessimistic mentions in it. This is something the folks over at RBC have worked out. And then we also had this survey from the Chicago Fed, basically saying that economic conditions, expectations for it, 6 to 12 months out are the lowest they've ever been since they started collecting the data in 2013. That's what we're looking at right now. Given these two opposing forces, the deterioration in expectations and the unrelenting nature of inflation, Francesco, what does a hard landing look like?
It depends market by market. I think that on the equities market, we are not so pessimistic because a lot has been already priced in terms of multiple compression because the anticipation of the Fed increase in interest rates. Probably what we have to see at the moment is the depth of the deterioration on the earnings. And the tricky part is the fact that the PPI, the producing prices, is very high in comparison to the CPI, signaling to some extent limited capacities of corporations to shift their pressure on cost on revenues. I think that it's very difficult to call for the equities the bottom at this point, and probably we have still 5, 7, 8% to go. But we are not very far from the level of correction that we have in mind to start reaccumulating.
All right, so perhaps just a bit more pain to go. Francesco, stay put, as Francesco Sandrini, head of multi-asset strategies at Amundi, is going to stick around with us. Now let's get to some of our top stories with the Bloomberg First Word News is Leanne Gerrans. Good morning, Leanne.
Hi, Danny. Bloomberg has learned that China is considering ending a near 2-year ban on Australian coal. The proposal, to be agreed by senior leaders, is prompted by fears that European curbs on Russian energy will increase competition for coal from China's main suppliers like Indonesia. This as Beijing looks to avoid a repeat of last year's power disruptions. The UK's Conservative Party will hold another ballot today in the contest to elect their new leader and Britain's next Prime Minister. The first round of voting saw ex-Chancellor Rishi Sunak and Trade Minister Penny Mordaunt emerge as the front-runners, with a field of 8 candidates now narrowed to just 6. The Fed's Loretta Mester says a hot US inflation print suggests officials should raise rates by at least 75 basis points later this month. The Federal Reserve Bank of Cleveland president spoke exclusively to Bloomberg after US consumer prices rose a faster than forecast 9.1% in the year to June. The Bank of Canada has hiked interest rates by a full percentage point, a surprise move amid fears 4-decade high inflation is now becoming entrenched. In Australia, meanwhile, a hiring boom gathered pace in June, sending the unemployment rate to the lowest in almost 50 years, boosting the case for a supersized rate increase next month. And Sri Lanka's president has missed a deadline for the parliament speaker to submit his resignation. Gotabaya Paxa fled the country for the Maldives as months of inflation-fueled protests did gain momentum. Earlier, protesters stormed the Prime Minister's office, leading authorities to impose a state of emergency. The Prime Minister has restated that Parliament will choose a new president next week. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Danny.
Leanne, thank you very much. Coming up on the program, Italy's government is threatened with collapse as coalition tensions spill over. We'll bring you the latest from Rome next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance, the early edition. I'm Danny Berger in London. Now, Janet Yellen is in Bali at the G20, speaking at the moment. Some lines there. She says inflation in the U.S. is unacceptably high. This is something that President Biden said yesterday as well. Yellen also saying that Biden administration, that they are supportive of the Fed's steps to control prices. Of course, this all reflects a similar language coming from the president yesterday following CPI. But he also did mention that the backwards-looking figure didn't reflect the 30 days of declines in gasoline. All right, now let's turn our attention to Italy, where the coalition government is at risk of collapse over dispute on a key aid package vote. For more, we're joined by Bloomberg's Tommaso Ebhardt in Milan. Tommaso, walk us through this. So the five-star doesn't have confidence in the current government. Why? What does it center around?
Hi, buongiorno from Milan. So it's a crucial day for Italian politics. The government is really nearing a proper crisis, and Mario Draghi is facing the highest tension in his coalition since he took the job in February 2021. There should be, but you know, we put a question mark here because it hasn't started the vote in the Senate yet. There should be a confidence vote this morning on an aid package. The five-star movement, now the second biggest party in parliament, said it won't vote for Draghi, and Draghi made clear that if he doesn't have the confidence of all his coalition, including the five-star, his government is dead. So it could be a crucial day. Mario Draghi may eventually even go and offer his resignation to the president later today. But as I said at the beginning, it's very much fluid at the moment. We are waiting to see when and if the vote takes place and what's next.
What does this all mean for Italy as a whole, be it the future of political volatility or economic volatility?
So that's a good question, Mark. Reaction today in the market is not, I would say, good for the country. The FTSE MIB, so the stock market is down, is probably the worst performing in Europe. The spread versus the German bond is higher, not massively higher, but anyway, it looks like the cost of Italian debt is going up again. So which is the risk? The risk is again putting Italy in a situation of instability. Since Draghi took the job 1.5 years ago, Italy was a sort of a land of stability in Europe. So we may go back to the old good or bad Italy political chaos.
Tommaso, grazie mille. Tommaso Ebhardt there from Milan. And staying in Milan, let's get over to Francesco Sandrini, head of multi-asset strategies at Amundi. Francesco, that's all I got in my Italian repertoire, so I won't try any more with you. But okay, Tommaso, they're talking about the political risk. We're looking at BTP's spreads wider on the 10-year by about 22 basis points. Game out for me the market impact of political volatility in Italy.
No, of course, there is an impact, and as Tommaso was correctly saying, is an impact that is still quite limited because still we do not have visibility. We have to understand where we are from the macroeconomic point of view because we are still in a framework in which, albeit deteriorating, we are still forecasting a decent growth for 2022, 2.3%, and 2023. And this is very much affected by deteriorating consumption, but what it is very solid is still the capex, so the investments from corporations that are to some extent taking some benefit from the next gen plan by the European Commission. So I think that this is very much what it is at stake with this crisis. It's hard to see at the moment what is going to happen, but would be a pity to derail this kind of positive upward trend of the Italian economy. In terms of BTP spreads implication, very quickly, until when the market will not be pricing a new political force discussing openly about an Italy exit as it happened in the past, so an exit from Italy from the European Union, I think that the pressures on the BTP will stay to some extent contained.
Okay, does that mean you're not generally worried about a form of a debt crisis or some other as we get the ECB hiking rates?
Let's say that I'm not yet, in the sense that I was expecting this to happen in any case in November, approaching the last 6 months of the Draghi administration. So I think it is very important to acknowledge that it's no one interest at the moment to create or to run a political campaign threatening to leave the euro as it happened in the past because of the massive fiscal plan that was deployed. And this is actually something extremely positive for the growth perspectives of Italy. So until when this will not put at risk, I'm still relatively concerned and relaxed, but I think this is not the trigger yet for massive blowing out of the debts.
Okay, so concerned, but perhaps not drastically so. I do wonder, though, as we get these political pressures, we look for different governments to give aid, be it to corporations, be it cutting taxes. I look here in the UK, that's certainly on the platform of a lot of those running to lead the Conservative Party. Francesco, is there a risk that the politics is something that continues to fuel inflation because of that pressure of a population that faces a cost of living challenge?
Absolutely. This is the name of the threat. Without any doubts, I'm totally with you. I think that the pressures on rising inflation are eroding to some extent the capacity of spending of the weaker cohorts of the population. So naturally, this is the perfect environment for populist parties to come back. And I think this is something that we start already seeing in France, this line of political instability that will probably spread to Italy moving forward. And this is the major risk that the European institutions have to face moving forward with a proper fiscal package in the future.
Francesco, thanks so much for joining us this morning. Francesco Sandrini, head of multi-asset strategies at Amundi. Coming up, a commercial break for Netflix. The streamer picks Microsoft as its partner for a new advertising-supported service after years of saying it wouldn't do ads. We're going to bring you the details next. This is Bloomberg. Welcome back to Bloomberg Surveillance. This is the early edition. We're looking at pictures of Yellen in Bali. She's there for the G20. She has said that inflation in the U.S. is unacceptably high. This is something Biden also said yesterday as well, but talked about the backward-looking nature of CPI didn't reflect the downdraft in gasoline prices. Yellen also saying now that no decision yet on Russia oil price cap level, but has been speaking about it, saying it would help to lower inflation in the U.S. Like a price plan would be worse for Russia, she says currently. She also is talking about China, saying that China should work to restructure Sri Lanka debt. Of course, we've seen that tension in Sri Lanka. Yellen just stepping off the stage there, but also talking about China, saying that she wants the G20 to put more pressure on China over debt. So Yellen there just wrapping up her speech at the G20. Now on to other U.S. matters. Netflix has selected Microsoft as a partner for its service with advertisements, which the streaming giant hopes will be running by the end of the year. Bloomberg's Laura Wright has been digging across the details. So Laura, what would this look like?
Well, Netflix fractionally lower in pre-market trading. And Dana, we first learned of the platform's intention to launch such a service last quarter. And interestingly, the average revenue per user would actually be higher on an ad-supported service, which is cheaper compared to the standard offering. Now, Microsoft was able to outmaneuver advertising heavyweights such as Alphabet and Comcast to clinch the deal. The COO of Netflix praised Microsoft's privacy protections. Netflix views privacy as imperative for its customers. Also, Microsoft is not seen as a direct competitor to Netflix, whereas Alphabet and Comcast both have their own video offerings, such as YouTube, NBC, as well another platform which escapes me right now.
Yeah, Laura, and of course we also have Netflix earnings coming next week. I believe it's the 19th. You can correct me if I'm wrong. But ahead of that, what are the headwinds that Netflix might be facing?
Yeah, well, Netflix has experienced some heavy losses already year to date, down almost 71%. Economic reopening, central bank tightening, consumers' incomes under pressure. And there are serious questions about the heavy content spend, forecast to be $18 billion in 2022 alone, to try and offset growing competition. But investors want to see returns now. Also, what is Netflix going to do about the additional 100 million households that piggyback off existing users' accounts?
Who Laura Wright may or may not be part of, me as well. We'll keep that a secret between us. Laura, thanks so much. Bloomberg's Laura Wright. Coming up, travel turmoil from London to Berlin, chaotic scenes playing out across Europe's airport. We're going to be joined by the CEO of Trip Abroad, Alexa Rathbone-Baker, to discuss. This is Bloomberg. US CPI scorches at 9.1% as the Treasury curve inverts levels not seen since 2000. King dollar pummels the euro to parity. Jumbo hike in play, markets see a 50-50 chance of a historic 100 basis point move, with inflation piling pressure on the Fed. Plus, rebound on the ropes. Draft projections show the EU slashing its GDP forecast with surging prices and an energy crisis. Good morning, happy Thursday, and welcome to Bloomberg Surveillance, the early edition. I'm Danny Berger in London, in for Francine Lacqua. Negative markets this morning, not much risk appetite, but not too drastic of moves, especially in equity markets. We're down 0.5%. U.S. futures down about the same amount, which is remarkable considering we just got this hot CPI reading yesterday that's fueling bets for a 100 basis point rise from the Fed next week. You think equities might be doing worse, but perhaps it's this idea that much of the recession is already priced in. We were talking to our guest, Francesco, earlier about that from Amundi, who said only a little bit further to go, perhaps, to price all this in. It could also be what we're seeing in the yield curve. Yes, you might think this is negative, bad economy, bad for stocks. It's at its most inverted since 2000. However, this bid for duration is because of the concerns about the economy. 30-year yields, that auction yesterday, very, very strong. That might indicate that duration is an okay place to be. And things like tech might be all right in the coming environment, especially if the Fed is going to start cutting rates in 2023. Check on the euro there. That is just above parity. It hit parity levels yesterday after the CPI report. And finally, the last thing you see there, that's BTP's Italian yields, your 10-year yield. Those are up by 22 basis points. There's concern around the Italian government, whether a coalition is falling apart. That means the spread between Italy and Germany, 10-year yields now at the widest in about a month. Now, our other top story today is the travel chaos. And travelers in Europe, they're paying ever more for a plane ticket, and yet somehow have less of a chance of actually making it to their destination. Now, Asia's travel industry, that's still navigating COVID-19. The U.S., for their part, it's a shortage of pilots. Ticket pricing and cancellation data show that Europe is where the turmoil is inflicting maximum pain on customers. We're joined now by Alexa Maria Rathbone-Baker, CEO and co-founder of Trip Abroad. It's an AI-based family holiday booking platform. And Alexa, if there's one group of travelers who perhaps are used to chaos and want to limit as much chaos as possible, it's those traveling with children and traveling with families. The sort of behavior you've seen on your platform, booking trips, have you seen any change in behavior or appetite with rising prices and concerns about what the trip to the airport will look like?
Yeah, well, firstly, thank you very much, Danny, for having me on the show. It's a real privilege to be here. So as you said, when you're thinking around going on holiday with your children, obviously it is quite concerning looking at the news stories and the reality of what's happening in the airports. However, I suppose what we're finding is that after so long not traveling, the desire to go away, certainly for families who have nearly finished the end of term or even finished in some cases, is very high. So the family segment was the fastest to rebound out of COVID, and currently is tracking at around 80% of what the levels were of bookings pre-pandemic in 2019. So the demand is still very strong despite all of the challenges that consumers are facing.
Is there a level you see, Alexa, where there will be demand destruction, that prices get so prohibitively expensive, or do you think the families are just saved up enough and they'll continue to be willing to pay up?
Yeah, I think families are very savvy around what they're spending their money on. And, you know, when you think around the experiences that their children have missed out on after so many years, really where they want to place their value is on making memories as a family. And this summer is really a kind of pivotal point to starting to explore the world again. What we are seeing certainly on our platform is that from a basket size perspective, we're trending well above 10x what the industry typically books on accommodation, and we're accommodation only platform. And so what that is showing is strong demand from consumers, but really a desire not to compromise on the things that they can control. So while there are challenges with how do you get to your destination, what parents and consumers can really focus on is making sure that they find the right place to stay and the right destination for their needs.
Alexa, what is the environment for funding right now as a tech-enabled travel company? Is there still demand and interest from investors?
Yeah, you know, it's a great question, because I think, you know, certainly when you look at some of the most successful businesses in the world, when you talk about tech startups, most of them were founded in a recession. And, you know, when you look at the travel industry and you look at the demand, I think the current situation in airports is only a strong reflection of consumer appetite to travel. And when you look at the areas that consumers are spending the most on coming out of the pandemic, it is travel and it's food. And so when you look at those sectors that want to go long on from an investment perspective and future value, I think it's a fantastic opportunity for investors to explore the travel sector. There are some amazing companies that are doing some really innovative things, and consumers are ready for a shift. And I think that's certainly what we've seen from a technology perspective, a tech-focused perspective in travel. Consumers have become more tech savvy, certainly our customers in terms of parents, and the expectations on the level of customer service in particular is much higher than it's ever been.
Well, what does competition look like, Alexa? Because you talk about the need, a lot of people want this type of service. Is there a lot of competition in this space?
Yes, so in terms of family travel, we're actually the world's first AI-powered family travel booking experience. And what we've done is we've said families are different to your typical traveler. They have different needs, they're more complex. And for too long, really, families have been squished into that sort of typical traveler model. And anyone who's traveled with kids knows that it's a completely different ball game when you have kids and you travel versus when you don't. And so, you know, we are really carving out that niche and that segment for parents and thinking about how do we build technology that thinks and acts like a parent thinks and acts when they're researching and booking their holiday. And we hold their hand through the journey all the way from booking to when they return from travel.
All right. Alexa, thanks so much for joining us. That's Alexa Maria Rathbone-Barker, CEO and co-founder of Trip Abroad. Turning to equities now, at the lows of the session, S&P 500 futures, those are down just less than 1%. We are looking at Russell 2000 futures. Those are down more than 1%. It really shows the economic angst that's playing through these markets. Stocks remarkably resilient yesterday in the face of a red-hot CPI. Will that last, though? We have University of Michigan data that's due out tomorrow. The Fed in the past has made these jumbo hikes move to 75 because of not just the CPI, but combined with UMich. So that could be another potential risk event for these markets. Perhaps we hang tight until then. Of course, we do see the bond market continuing to be under pressure, yield curve at its most inverted since 2000. Coming up, a gas-hungry Europe revives coal plants, complicating its climate ambitions, and a blistering heat wave across much of the continent shows just what's at stake. That's as Dutch nat gas futures, little change today. We'll get into the big take. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance, the early edition. I'm Danny Berger in London. Well, after yesterday's CPI, it's all about King Dollar and the yen being impacted by it for a second day. Currently, the yen is at 139.24 at a fresh new high. Of course, the highest since 1998. Will it reach 140 as the Fed is forced to put their foot on the pedal? Will it be 100 basis points? As that gets priced into the market, we continue to see the pain in the yen with yield curve control. The BOJ so far not letting go of that. Now, turning to Europe, a gas-hungry Europe reviving coal plants, complicating its climate ambitions, the blistering heat, all of that together in this summer shows what's at stake. That's today's Big Take. A little bit of rhyming for you there. NI Big Take Go is where you find it on your terminal. But for more, let's get to one of our authors of the piece. It's Bloomberg's John Anger. So, John, what's happening across Europe right now? To break down those forces for us and what the implications of them are.
Hi, Danny. Well, yes, as you're probably well aware, sitting there in London, we are being hit by a big heat wave at the moment in Brussels too, and across the rest of Europe. And that's having some quite damaging effects. Most notably, rivers are being dried up. That has a number of impacts from generating power, possibly closing nuclear power stations. Water is needed for the steam to generate electricity. But there's also other impacts. You could start to see food prices rise even more as crops die and wilt. We spoke to one person in our article today who's having to harvest their crops during the night for fear that sparks generated from hot tractors could set off fires. So this is really adding to what is already a very complex picture in Europe with regard to the economy, to inflation, and also just to the bloc's climate ambitions, which it's important to know are incredibly important to keep on track at the moment.
Yeah, John, dig more into that. What does it mean for those ambitious climate plans?
Yes, so we know last year, before everything kicked off between Russia and Ukraine, that the European Commission and the EU more broadly enshrined into law a commitment to reach climate neutrality by 2050. And as part of that, they unveiled a raft of new legislation, from phasing out the combustion engine in cars to reforming the bloc's carbon markets, to energy efficiency, to boosting renewables. Now, all of these are kind of still on track. Over the last month, both EU Parliament and member states have made progress and have come to their own conclusions on the positions. But we know as well that in the short term, as you mentioned in your opening segment, that coal plants are being restarted. And now that means that over the next couple of years at least, emissions are quite likely to rise. And so for the EU to meet its climate ambitions, it's going to have to act faster later in the decade to make sure that the 2030 goals stay on track.
So how is the bloc then, John, trying to balance ridding itself of Russian fossil fuels, again, given the environment that you're describing?
Well, right now, that's one of the biggest headaches that political leaders in Brussels have. So yes, as you said, on the one side, it really needs to get rid of that Russian dependency. Before the war, the EU imported around 40% of its gas from Russia. It wants to bring that down to 0% in the next few years. But at the same time, it wants to keep its climate ambitions on track. So in the short term, what the EU is trying to do is secure alternative supplies of gas, liquefied natural gas in particular, from countries like Qatar, from Azerbaijan, from the US. But in the longer term, it really wants to see an acceleration of renewable energy. And that could mean faster permitting for wind farms, for example. Or it could mean that when we build new houses in the EU, that those might have to have solar panels on the top in order to really pivot to this net zero economy that the EU wants to have.
John, thanks so much, and great work on the Big Take today. That's Bloomberg's John Anger. And if you'd like to read the piece on the Big Take, again, NI Big Take is where you want to head to on your terminal. Now let's get to your Bloomberg Business Flash. With that is Leanne Gerrans. Hi, Leanne.
Hi, Danny. TSMC has reported better than expected earnings. The latest signal that electronics demand is holding up better than feared. The results from Apple's most important chip maker may allay fears about an economic slowdown and soaring inflation. The euro has crossed a major threshold, dropping to parity with the dollar for the first time in 2 decades. The single currency's 12% decline this year comes as Europe's energy crisis and recession risks weigh on sentiment, and risks fueling a further spike in inflation for consumers. And Netflix has chosen Microsoft as the tech and sales partner for its new advert-supported streaming service. Now that's set to launch in the fourth quarter. The absence of ads has long been a selling point for Netflix, but slowing growth has forced a streaming giant to look for new ways to grow their revenue. And that's your Bloomberg Business Flash. Danny.
Leanne, thanks so much. Another banking earnings season, it has arrived. JP Morgan will step up to the plate first, offering investors a sense of how lenders have fared over the past quarter amid the slowing economy. Now, expectations for the sector, they are mixed. Analysts focus on the bank loans loss provisions, reflecting their assessment of recession risk. That will be really what we laser in on. For more, we're joined by Bloomberg US finance team leader Michael Moore. All right, Michael, so we have a few reporting today. What are we expecting?
You know, I think we're expecting a sharp divergence in the two Wall Street businesses. Trading doing quite well, seizing on the market volatility as investors have repositioned. That's created a lot of activity for the trading desks. So that's expected to be a boon. But investment banking, on the other hand, has slowed significantly, both on the deal side. IPOs have largely disappeared. Even debt issuance is down. So I think you're going to see some dramatic changes in those businesses from a revenue perspective. And then there's going to be the benefit from higher rates. We'll see that come through with the net interest income. It's expected to be up significantly for most of the banks. And that will probably continue this year as the Fed continues to hike.
Right.
But as you noted, the big question is, what happens to the economy?
Yes.
How bad does it get? Are we going to see a divergence of opinion from these executives?
Yeah, are we in a hurricane?
Yes, as Jamie said.
To that point, I mean, will any of that stress, you think, show up in lending operations this quarter, or is it more going to be looking ahead?
I think because the credit provisions have to be, by definition, forward-looking, I think you will start to see it show up. And whether we see banks, have different approaches to that, of, different expectations of how bad it's going to get, that may show up not just in their commentary, but in the level of provisioning they do. And, as Jamie has raised the question of the hurricane, is it a Category 1 or a Category 5?
Has he named it yet?
Yeah, exactly.
All of the important questions.
Yes.
In terms of dispersion among the banks, any differences we might see? What should we look out for there?
I think you'll see that in the credit provisioning, but also, the business mix. The higher rates is certainly going to benefit the Wells Fargos and Bank of America's, the large retail operations. But within the Wall Street side of things, who seized on this trading environment? We saw that in the first quarter where, it was an active market, people did well, but there was definitely gradations of how people did. You saw even in Europe, Deutsche Bank did quite well, Credit Suisse struggled. So do we see any of those divergence?
Okay, Michael, thank you very much. That's Michael Moore from our finance team, giving us a preview again. JP Morgan, Morgan Stanley due to hit later today. We are looking at risk sentiment more generally falling apart as we get closer to the U.S. Open. We're looking at oil now declining pretty forcefully. Brent, that's down 1.8%, but WTI crude down 2%. A lot of fears here in terms of demand destruction, high prices, an economy that's on the back foot as we see inflation hit 9.1%. Of course, the backdrop for oil is also President Biden, who's in the Middle East right now due to travel to Saudi. There might be conversation there about releasing more oil, producing more oil, but still, that's not what it's about right now. It's about those macro forces in a still very tight market. Also looking at the energy sector, that's falling some 2%. In general, I should say, stocks are falling. We're at the lows of the session for U.S. futures, down 1.2%. What's performing the worst? It is tech and it is small caps. So two forces going on there. If small caps are underperforming, it would stand to reason it's the same force of oil, of that economic concern for those sensitive stocks to the economy. But if tech is also selling off, NASDAQ futures, those are down 1.2%. It's those fears of a rate hike. The NASDAQ actually outperformed yesterday, perhaps because there was that bid into duration. There still is a slight bit of that today. We're mostly seeing bonds selling off so far this morning, but it's that yield curve. It continues to get more steep, to get more negative, I should say, steep, but in the opposite direction. Currently, your 2s, 10s, that is at a negative 23.5. That is its most inverted since 2000. Coming up, we're going to continue that conversation. Inflation, it's remaining stubborn. Recession risk, they have risen. It's being reflected in the market today that is selling off. And then there's the warning from Loretta Mester. We're going to all of that with our exclusive interview with the Cleveland Fed president next. This is Bloomberg.
It was uniformly bad. There was no good news in that report at all, was that inflation remains at an unacceptably high level. We at the Fed have to be very deliberate and intentional about continuing on this path of raising our interest rate until we get and see convincing evidence that inflation is turned the corner, is on a downward path, and is sustainably on a downward path, and that we just have more work to do.
If we had asked you about 100 basis points a couple of weeks ago, 2 or 3 months ago, I don't even think we'd have thought to ask you. Is that something, though, you could see being discussed? Would you discuss it? Is it something, given what we see in inflation now, that is, quote unquote, on the table, that maybe has to be under consideration because the Fed has to figure out just how aggressive you have to be?
Well, we're going to have the meeting and we're going to talk about what the appropriate path of policy is. And again, you know, we don't have to make a decision today. We're going to take into account all the data. But, you know, we're having this conversation. The markets are having a conversation and putting their money where their mouth is in terms of where market expectations are. So we're going to be talking about the appropriate path of policy. And I have not seen any convincing evidence that inflation has turned the corner. Certainly, the inflation report suggests that there's no reason to say that a smaller rate increase than we did last time, right? Because nothing moved in that direction.
Cleveland Fed President Loretta Mester there on that 9.1% inflation reading for June. And that impact of that inflation reading, the fear of how far the Fed is going to go, will it be 100 basis points, and what that means for the economy, those effects rippling throughout markets, I would say even more intense this morning than it was yesterday. The GMM, it is all red, save for King Dollar. That is up 0.6% for your Bloomberg dollar spot. A couple interesting things here to highlight. You'll look at the top of equity markets for the worst selling off and sovereign bonds. It's Italy. And it is Italy. FTSE MIB down 2.2%. It's not just the fear of widening spreads as you get the ECB needing to act as well. It's also political drama in Italy of fear over a coalition government that might fall apart. So in foreign exchange, you see yen, a fresh high there. That is at trading at 139, its highest since 1998. In commodities, all red. It is the fear of growth. Iron ore, that is down 6.8%. Crude, that is also down 2%. Bloomberg Surveillance early edition. It'll continue in the next hour with those market moves. Matt Miller and Kailey Leinz in New York and Anna Edwards in London. This is Bloomberg.
It all comes back to this inflation story.
Every developed market is facing the same problems in terms of high inflation, slowing growth, declining real wages.
This report reflects that inflation is unacceptably high. Our economy looks well positioned to deal with the challenges faced by the Fed.
This is going to amp up pressure on policymakers, both in the White House and monetary policymakers, to make a stronger move to provide near-term relief.
We don't have to make a decision today. We're going to take into account all the data.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kailey Leinz.
It is 5 a.m. in New York, 10 a.m. in London, 5 p.m. in Hong Kong. Welcome to Bloomberg Surveillance Early Edition. I'm Matt Miller with Kailey Leinz. Anna Edwards is with us out of London. Our top stories today: the Fed could be on the verge of an historic rate hike. The latest inflation report may push the central bank to consider a full 1% increase this month. Meanwhile, Wall Street traders are raking it in. The biggest U.S. banks are expected to report a double-digit increase in trading revenue. J.P. Morgan and Morgan Stanley kick off earnings season today. And Biden in the Middle East day 2. He'll commit to extending a military agreement with Israel and prepare for that crucial meeting with the Saudi Crown Prince on Friday. So a lot going on this Thursday morning. Let's get a look at how the markets are doing, starting with Kailey Leinz here on what's happening in Asia. Kailey?
Well, it was a mixed day in Asia overnight, Matt. On the one hand, you had Japanese equities higher, but in Hong Kong, they were lower, for example. So you put it all together, and the MSCI Asia Pacific Index was actually down by about 0.5%. The market, of course, really focused on that hot inflation and the aggressive, supersized moves that central banks are making. New Zealand, of course, was one of them yesterday, the third half-point hike in a row. And as a result, the two-year yield up 16 basis points overnight to around 3.52%. Now, of course, while other central banks are hiking, the Bank of Japan is absolutely not. They are keeping policy easy, and especially as there's now a conversation about the Fed potentially moving 100 basis points this month, that rate differential story just becomes more and more exacerbated. So that is dragging on the Japanese yen. It is at a fresh 24-year low against the U.S. dollar. Right now at 139, that is the weakest level since August of 1998. And finally, given all the concern out there that the central banks are going to go too hard, that they're going to lead to an economic slowdown or potentially a recession, that is weighing on commodities, given the demand fear out there, including iron ore down 7%, now at its lowest level since December, trading just above $101, Anna.
Kailey, let's have a look at the European equity market picture. And things are worsening, actually. As we go through today's session, you can see the map looks pretty uniformly red, in particular in Italy. But we are seeing some negativity across European equity markets today. And really, it is that same picture hangs over global markets. Just how much tightening are we going to see from the Fed, and how much tightening do we see from global central banks? Also, very much part of the conversation. We're just getting some news out of the euro area. Revisions to their forecasts, their estimates for where GDP and inflation goes in the Eurozone. And we had a draft copy of this earlier on. So this not necessarily new information, but confirming what we already knew essentially from the euro area. So GDP to grow by 2.6% in 2022, 1.4% in 2023. So they're downgrading their growth expectations for the euro area. They are upgrading their inflation expectations. Inflation for 22 seen at 7.6%, then 4% next year. So even that not back down to target during next year. So that's the data picture, that worsening data picture across Europe. Let's have a look in more detail at what we see on European markets today. Then I showed you the sea of red that we had on the European map there. Well, a lot of that coming, or some of that coming from Italy. And there's a lot of politics to talk about in Italy today. And we'll do that in just a moment. We'll get an update on what's going on from our colleagues in Rome. But the Italian stock market down by just over 2%. A lot of nervousness as to whether Mario Draghi will still be Prime Minister by the end of today. And we should learn more about that in the next couple of hours or so. Bank stocks very much to the fore when it comes to that falling stock market story over in Italy. Also, that same story having an impact on bond markets. It's sending yields higher on BTPs, that's Italian government debt. It's also widening spreads between BTPs and German debt. I put in the euro dollar as well here, Matt, because we spent quite a lot of time on Parity Watch and blinked and you missed it. We did go down below parity for the euro against the US dollar, so a number below 1. But we've climbed back up above that, only just. We're at 1.0027. You need at least 3 decimal places to catch that. What do you see on U.S. markets, Matt?
Yeah, we see S&P futures down more than 1% right now, and they're declining. So I had to do a double check here because when I looked just a few minutes ago, they were down 0.8%. So continues to worsen here. And remember last time we got that big inflation print on June 10th, we saw a drop of 2% on day 1 and then 4% on the next trading session. So maybe today will be worse as investors digest this and also get producer price index, which is so important, of course, to earnings margins. The 10-year yield right now up about 4 basis points at 297.43, but still holding below 3%. So still maybe a little bit of a support to the S&P, although as you can see, futures continue to move lower and lower. NYMEX crude also continues to move lower, down $2.70, $93.56. Almost seems cheap right now. So not only below 100, but $7 down. And Bitcoin right now up about 0.5%, but still holding at that $20,000 level. So 19,765. The interesting thing here is that yesterday's 9.1% CPI print didn't destroy Bitcoin. Remember, last time we had a big CPI print, Bitcoin went down another $10,000 in a few trading sessions. And so far, we haven't seen that yet, Kailey.
Yep, still in that range. The question is, how long does that last? So aside from being on Bitcoin watch, let's take a look at what else is ahead today. The UK Conservative Party will be holding another ballot in the contest to elect a new leader and new prime minister. At least one of the 6 remaining contenders will be knocked out after Tory MPs vote. Then we'll get second quarter earnings from Wall Street banks. It's kicking off with JP Morgan and Morgan Stanley later this morning. Then, as Matt mentioned, 8:30 a.m. New York time, we will get that crucial US PPI data. Does it too come in hot? And we'll get live reaction from officials on the Federal Reserve at 11:30 a.m. Eastern. Fed Governor Christopher Waller will be participating in a Q&A moderated by Bloomberg Television's Michael McKee. Matt.
All right, so we're paying very close attention to the Fed, obviously. And the Fed may debate an historic 1 percentage point rate hike later this month. That's after another searing inflation report piled pressure on the central bank to act. We haven't seen moves that big since Paul Volcker. Atlanta Fed President Raphael Bostic told reporters yesterday that everything is in play, and then he repeated, he means everything. Cleveland Fed President Loretta Mester told us exclusively that she supports at least 75 basis points in July.
Certainly, the inflation report suggests that there's no reason to say that a smaller rate increase than we did last time, right? Because nothing moved in that direction.
Bloomberg Markets correspondent Kriti Gupta joins us now to talk about what we can expect. So at least 75, right?
At least 75. At least that seems like that's the consensus from the Federal Reserve. But remember, Nomura actually came out ahead of it and said, well, the market's pricing in 100. We think it's going to go to 100. There's always the questions about the psychological level and effect that has on the actual American consumer. Is the Fed actually concerned about just perhaps how aggressive they should be if they're hitting that 100 level? That's going to be something that comes up. But let's talk about the market moves here, because you mentioned this is the biggest inflation move since Paul Volcker's time. Well, let's put this into perspective for the markets, because the 2s-10s curve is inverting. Consensus is that, and we're looking at a chart of it right now for our radio audience, stick with me. The 2s-10s curve is really important as a recession indicator. The consensus here is that it has to stay inverted for at least 2 to 3 weeks to really foresee a recession. It is now down negative 23 basis points. But if you go back in history, it tends to drop about 40 or 50 basis points before recessions. If you go back to Volcker's time, it dropped over 200 basis points, so negative 200. We are a far cry from that. But it really does put that into perspective. Even though you're seeing inflation extremely high and really paralleling what you're seeing 40 years ago, that's not necessarily the case in the markets at the moment.
Kriti, thanks very much. Bloomberg's Kriti Gupta with the latest on the Fed and the Fed's market reaction. And Kailey, thinking about what we saw from the Fed, or what we saw from inflation data rather, and what that means for the Fed, and thinking about where we go now on the earnings story, of course, the banking sector, one sector that'll be front and foremost in the days ahead, and one sector that should benefit from increasing interest rates, but recession fears could hang over the sector as well.
Yeah, that's really the catch-22, Anna, because on the one hand, rates are higher. In theory, that helps with net interest income. Also, given all of the volatility that is out there, it can help on trading too. But in the face of higher rates, what's happening to loan growth, especially mortgages, and the kind of commentary we may get around the health of the consumer and the prospects of a recession is definitely something we're going to be paying very close attention to on the earnings call. So let's get more on this now, as another bank earnings season is just a couple hours away. Bloomberg's finance and Wall Street correspondent Sonali Basak is with us now. So Sonali, JP Morgan kicks us off. We'll get Morgan Stanley later this morning. morning. What are the primary things you are watching for?
Yeah, trading is obviously expected to rise, and JP Morgan would be a big beneficiary of that, given the volatility in rates trading and commodities. They are the gorilla in the room when you look at those businesses. And Morgan Stanley, remember, equities volatility was up, but the equities business with such little issuance was so pressured. With that said, JP Morgan and Morgan Stanley are trading more richly than almost any of the other banks. You have to wonder how much more these banks have to fall when you have Goldman Sachs, Wells Fargo, and Citigroup all trading just below book value. So they've sold off quite a bit, but again, trading gains are very volatile. Can it get any better than this?
We're going to be watching also very closely loan growth. Net interest margins are interesting right now because we're in a rising rate environment, but we have an inverted yield curve.
Yeah, and that's certainly true. And you have to wonder if JP Morgan will start to announce provisions for loan losses again with the deteriorating economic condition. You know, Jamie Dimon doesn't love to play Jay Powell, but he will get asked a lot about the meaning of a 100-point rate hike for him. How much more will that contribute to net interest income? And this inverted yield curve, at the end of the day, they did give very specific guidance earlier on what an inverted yield curve and a flatter yield curve would mean on net interest margins in the future. How much worse can it get?
Yeah, I'm really looking forward to today's hurricane forecast from Jamie Dimon. Bloomberg Sonali Basak, thank you so much. Now let's turn to the Middle East. President Biden is expected to announce his commitment to extending an agreement that provides billions of dollars for the Israeli military. The president is in Israel and has been meeting with the prime minister there. Anne-Marie Horder, Bloomberg Washington correspondent, joins us now from Jerusalem for the latest. Anne-Marie, what's the latest from the ground?
What we do know is that there's going to be this expansion of this declaration, that they agree that they want to expand it. Right now, the current deal with billions of dollars for Israeli defense goes through 2028. We don't have an end date on where the Biden administration could see that expansion last, but it just shows the commitment and that steadfast relationship you have between Washington and Israel when it comes to their defense. This is critically important for Israel, especially as they view Iran in the region as a massive threat. We should note, though, it wasn't without its fraught negotiations in the past when the Obama administration was dealing with former Prime Minister Benjamin Netanyahu, who President Biden will also meet today. He's now the opposition leader. There was a lot of disagreements when they were hammering out this defense deal because the Obama administration was trying to do this nuclear deal with Iran. So there have been hurdles in the past, but really it's just a deliverable that you can almost expect every time a U.S. president comes to Israel.
And there was also a lot of camaraderie with the Israelis, a lot of handshaking, almost hugs, right? What do we expect tomorrow when the president meets with Crown Prince Mohammed bin Salman in Saudi Arabia?
It's a great question because this is going to be incredibly important, not just in terms of what the deliverables are in the kingdom with the United States, but just the human interaction between these two people. Mohammed bin Salman, the president, Joe Biden, when he was campaigning, vowed to make a pariah. The White House going into this trip said they were limiting handshakes. They didn't want to have handshakes due to COVID precautions. But nearly 20 minutes outside Air Force One, you see the president shaking lots of hands. So there is this expectation that potentially he's going to have to shake Mohammed bin Salman's hand. And this is a president who released that intel report that said that this individual approved the killing of Jamal Khashoggi.
Anne-Marie, thanks very much. Bloomberg's Anne-Marie Horder with an update for us on that trip from Jerusalem. Now, here in the UK, another round of Conservative Party balloting is set for to take place. That will determine the next Prime Minister, of course. The field of candidates has now been cut to 6. Former Chancellor Rishi Sunak and Trade Minister Penny Mordaunt have emerged as the two front runners at this stage. At least one member of the field will be knocked out after today's vote. Elsewhere, there's political turmoil in other parts of Europe, namely in Italy. Italy's five-star movement will refuse to back Mario Draghi's government in a confidence vote today, raising the prospect that the Prime Minister might have to offer his resignation. Let's get more from Alessandro Speciale, our Rome bureau chief. Alessandro, very nice to have you with us. So this might see Prime Minister Mario Draghi going to see the president and offering his resignation, but I understand that might not be accepted. Give us a sense of how this might play out.
This is very complicated. Italy is sort of turning itself into one of its usually very complex, very convoluted crises. So we expect there to be a confidence vote today in Rome. This is not even 100% certain, as they are trying to find alternatives. And if Conte and his five-star movement sit out, then Draghi will go to President Mattarella and hand in his resignation. And after that, it's in Mattarella's hands to try and find a compromise and avoid early elections, avoid a government crisis in the middle of an energy crunch and of Russia's war against Ukraine.
All right, well, we'll have to see how this one plays out. Bloomberg's Alessandro Speciale, thank you so much joining us from Italy. Now let's get back to the U.S. and take a look at some stocks moving in pre-market trading here in the States. I have to begin with Tesla, which is lower in early hours, and there's a few things going on here. On the one hand, you had news overnight that its top AI and autopilot executive was leaving the company. Then this morning, Adam Jonas over at Morgan Stanley cutting his price target on the stock as well as on GM and a number of other companies, citing economic headwinds. That price target from Adam Jonas now stands at $11.50. It's trading at $7.03 this morning, down about 1%. You also have some stocks moving lower, even though we've gotten some maybe positive news. That would be Netflix introducing commercial or advertising revenue service by the fourth quarter. They have selected Microsoft as their partner in that effort. Of course, as subscriber growth wanes, they're trying to figure out other methods of monetization. But Microsoft is down about 0.9%. Netflix down by about 1% as well. And finally, one more analyst-related mover to talk about. That would be Cisco, downgraded at JP Morgan, $51 price target on the stock. It's trading just south of $42 a share this morning, down about 2% before the bell, Anna.
Kailey, coming up on this program, we will get to the economics with Anna Titareva, UBS European Economist. What does she make of the aftermath of that CPI data out of the United States? What does it mean for Europe and the pace of rate hikes here in Europe? We'll also talk about the European Commission cutting its GDP forecast and upping inflation guidance. On that note, don't miss our interview with the EU Economy Commissioner Paolo Gentiloni. That is at 11 a.m. at New York time, 4 p.m. here in London. Plus, the dangers of weakening climate goals. Today's Big Take story shows what's at stake as Europe turns back towards coal power in the blistering summer heat. Look for that on Bloomberg.com or by typing NI Big Take into your Bloomberg terminal. This is Bloomberg.
Welcome back to Bloomberg Surveillance. This is the early edition. We are simulcast on both Bloomberg Radio and Bloomberg Television. We got a pretty shocking inflation printout yesterday. CPI up 9.1% year over year, and we're going to get PPI out a little bit later. PPI has actually been produced, the producer price index, rising at an even faster pace than the consumer price index. And that's a concern for company margins as we start earnings season. Joining us now is Justina Lee, Bloomberg Markets reporter, to talk about, Justina, how is this inflation, this accelerated inflation, affecting market assets?
Yeah, I mean, those CPI prints yesterday were pretty worrying. We saw inflationary pressures broadening kind of beyond, just the goods category. And we kind of got a pretty interesting response in bonds, which was that, the front end yield surge, the kind of the longer end, from 10-year onward, didn't move as much, and which was why we had the yield curve invert. And what that really shows is that people are quite convinced that the Fed won't be able to avoid a recession in this process of tightening its policy, to the extent where we're actually starting to see markets price in rate cuts as soon as next year.
It's interesting thinking about, where the market's focus is, and it's been pivoting away from inflation towards recession fears, and then we get a rude awakening yesterday that we still need to think about inflation. With that in mind, though, interesting to see how fast some commodities, Justina, have been falling. And there's a red headline across the Bloomberg right now, says iron ore crashes below $100 a ton amid China property turmoil. And this is coming from sort of, yes, we've been nervous about China for a while, but seeming turmoil in Chinese property markets coming from left field to remind us of risks to growth.
Right, exactly. I mean, we haven't really had a lot of good news out of China lately. I mean, sure, maybe they will step up stimulus, but with kind of COVID-0 not changing, I mean, that demand picture is still, pretty worrying. Of course, kind of on the inflation front, we are expecting to see a bit of help from gas prices coming down, from July onward, probably. But I mean, we have seen from yesterday that there's still a lot of pressure on the services front, on the shelter front.
Yeah, okay, Justina, thank you so much. And that iron ore price there down by 8% in just today's session. Thanks to Justina Lee. And for more market analysis, check out MLIV Go. That is the function to use on your Bloomberg terminal. That's where you'll find the Markets Live blog. They'll be reacting to all of these market moves for you. This is Bloomberg.
Now keeping you up to date with news from around the world, here's the first word. In Tokyo, the government has raised the COVID infection alert to its highest level. Almost 17,000 infections were reported in the city Wednesday, compared with 3,500 on July 1st. So far, the number of severe infections remains low. The U.S. Senate is getting closer to a deal on President Biden's economic agenda, but the state and local tax deduction issue threatens to spark a showdown among Democrats. Senator Joe Manchin has been negotiating with Senate Majority Leader Chuck Schumer. Manchin says the federal deduction popular in high-tax states known as SALT hasn't been in the mix. That could doom the bill's prospects. And there's another big-name casualty from the $2 trillion cryptocurrency crash. Crypto lender Celsius Network has filed for Chapter 11 bankruptcy protection in New York. Celsius had amassed more than $20 billion in assets by offering interest rates as high as 18% to depositors. It halted withdrawals last month in the midst of a panic run by clients. Coming up, we'll get back to the markets and the inflation picture and what central banks will do about it. Anna Titareva, UBS European Economist, joins us. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. The Fed could be on the verge of an historic rate hike. The latest inflation report may push the central bank to consider a full 1% increase this month. Critics blame the Fed for its initial slow response to rising prices. Wall Street traders are raking it in. The biggest U.S. banks are expected to report a double-digit increase in trading revenue. Meanwhile, investment banking revenue likely plummeted. J.P. Morgan and Morgan Stanley kick off earnings season for the banking sector today. And Biden in the Middle East, day 2. He'll commit to extending an agreement with Israel that provides billions of dollars in military aid. Plus, he'll prepare for that crucial meeting with Saudi Crown Prince Mohammed bin Salman on Friday. I'm Anna Edwards in London with Matt Miller and Kailey Leinz over in New York. And sentiment pretty weak for risk assets here in Europe, Matt, as we head towards the start of U.S. trade.
Yeah, weak and getting worse. So we have S&P futures that are down more than 1% right now. Investors are selling S&P futures down more and more throughout the session. Although it's been holding here for about a half hour, it was down just 0.8% about 40 minutes ago. The U.S. 10-year yield is rising a little bit. We're up 2.5 basis points now at 295.95. So investors are selling off that debt at least, and that could be what's holding us back from bigger losses on S&P futures, right? If you're yielding more on the S&P than you are in the 10-year. NYMEX crude down $2.60 a barrel to 93.70, so relatively low level for NYMEX crude considering what we've seen lately. That could show you recession concerns, and of course a lot of that has to do with the Fed raising rates at least 75 basis points. That's the consensus now for July 27th, but possibly 100 basis points. Still not like a 5% hike that we saw from Paul Volcker, so not exactly the most ever. Bitcoin right now holding up about 0.4%, 19,731. It's not terribly interesting because it's been at this level, except for the fact that it hasn't dropped lower, right? After a 9.1% CPI report, you may have expected a bigger drop in Bitcoin. Kailey?
Well, you may not be seeing that much of a drop in Bitcoin, but you definitely are seeing declines in large cap technology again today. Now, there is some specific stories that are worth noting, including for Tesla, its top AI and autopilot chief leaving the company, plus its price target cut at Morgan Stanley to $11.50. That stock is trading around just below $703 this morning, down about 1 percentage point. But of course, also overhanging large cap tech in particular is the prospect of higher rates, a more aggressive Federal Reserve. And as a result, you have Apple, Amazon, Meta, all down in the ballpark of 1% before the bell as well, Anna.
Kailey, let's have a quick look at what's going on here in Europe. I mentioned to Matt that sentiment had deteriorated, and that's certainly true. We've seen European equity markets under pressure, down by 0.9% on the stock Europe 600. A lot of focus on Italy. We got a report from Rome earlier. We'll continue to monitor these headlines. We've seen confirmation that the Italian Parliament is going to hold that confidence vote today, and the Italian FTSE MIB is down by 2.2%. A lot of pressure coming through on Italian bank stocks in particular. We also see the Italian 10-year yield in focus. Those yields on the rise, spreads widening as there's nervousness about whether Prime Minister Mario Draghi will still be in post by the end of today. Let us keep with the economics and think about where we go on the global economic agenda. Anna Titareva joins us, UBS European Economist, on set now. Anna, really nice to have you with us. And I'll actually start here in Europe because we've had some news lines coming through about expectations for European growth this year. I know we've got a lot to talk about on the US CPI front as well. But we've got this briefing taking place from Paolo Gentiloni of the European Commission saying that the EU needs to prepare for an economic storm over gas. I wonder what that looks like from an economic perspective. What are you starting to factor in when it comes to the gas taps possibly being turned off? What damage will that do to the European economy?
Yes, I mean, in terms of our baseline, we still work with an assumption that we get high energy prices, but no disruptions in terms of volume of energy being supplied to Europe. However, we recently did an exercise where we laid out several recessionary scenarios, and based on this exercise, we showed that the deepest recession in the Eurozone would be, in fact, caused if we lost all of the gas supply coming from Russia. But even in the case, if Europe, let's say, went into more of a preemptive gas rationing, this would still push Eurozone into a recession.
I mean, the European Commission themselves actually predicting recession for two countries, two in the east, though, and two smaller parts of the Eurozone, Estonia and Lithuania, they see going into recession in 2022. I suppose the big concern is going to be Germany. Is the way that this works is gas flows turned off and there's a cutback in the level of operations from German industry? Is that what's going to be the big factor from an economist perspective?
So I think it's important to flag that the first important step happened when the German government went into the second stage of their gas emergency plan. Now, at the moment, it doesn't mean rationing. It means more monitoring, working closer with network providers, etc. But by moving to the second stage, that also sort of automatically increases risks of moving to the third stage, which would then imply rationing. Now, at the moment, we don't have the details how the gas rationing plan would work, but we do know that under this plan, households and essential services would be protected. So a bulk of this rationing would likely have to be done by the industry.
Is there anything that governments can do on the supply side, Anna, anything that makes you hopeful?
We've already seen some of that happening at the start of the year. We've seen that there was a big increase in LNG imports. We've also seen governments working really hard trying to secure alternative gas supplies. So that's been happening. But at the moment, if we lose eventually all of the Russian gas, that's unlikely to be sufficient.
Okay, so let's talk about how this translates into monetary policy. Of course, we're having a conversation now about the Federal Reserve potentially hiking 100 basis points in a couple of weeks. And we had Gary Shilling on this program yesterday, and he talked about global central banks being a kind of cartel and essentially them all moving together. If you're seeing 100 basis point rate hikes out of the Federal Reserve, what kind of position does that put the ECB in, given, yes, they're dealing with inflation, but the growth outlook is deteriorating rapidly?
Yes, in terms of our baseline, we still think that ECB will start with a 25 basis point hike in July, and then will continue with 50 in September, and then 25 in October and December. We do think that, given all the growth worries, the ECB will still go ahead with hikes over the summer. However, if we end up in one of the recessionary scenarios that I laid out earlier, we could potentially see ECB taking a pause later in the year. But at the moment, we still think that sort of July and September hikes are firmly on the table.
And let's talk about how the currency factors into all of this as well. Paolo Gentiloni, in those remarks he's making in Brussels, now saying that the euro is showing strength, but the dollar is strengthening more. So it's a story both of dollar strength and then also euro weakness. How does a euro at parity factor into your economic outlook, Anna?
Weaker euro is definitely sort of pro-inflationary. We tend to work with sensitivity that 1% depreciation in euro effective exchange rate adds about 10 basis points to headline inflation. If we look at euro effective exchange rate since late June, it's now down around 2%. So it is sort of providing additional worries on the inflation front. So that's something that also ECB said they will take into account. But we also have to remember that given that companies are using some hedging strategies, the impact of weaker currency is likely to feed through relatively gradual.
What about the impact of the yen?
Well, from the euro perspective and from the European perspective, again, this is sort of captured by the effective exchange rate of euro.
Anna, thank you very much. Thanks for joining us. Good to get your perspective. Anna Titareva of UBS. Coming up on this program, we'll pivot from the macro story to the bank earnings story. The two are linked, of course. Walter Todd joins us, President and CIO of Greenwood Capital. We'll get his perspective on the forthcoming bank earnings season. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the principal room. Coming up later today, European Commission Commissioner for the Economy, Paolo Gentiloni. That's at 11 a.m. in New York, 4 p.m. in London. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York and Anna Edwards in London. Well, earnings season kicks off in the U.S. today with the big banks. J.P. Morgan and Morgan Stanley both reporting before the bell this morning. Then Wells Fargo and Citi are due tomorrow. Bank of America and Goldman will be rounding things out next week. Of course, investors will be on the alert for comments on the economic outlook as well as the actual headline numbers. Joining us now is Walter Todd, President and CIO of Greenwood Capital. Greenwood Capital owns both J.P. Morgan and Bank of America in their large cap strategy. So Walter has skin in the game. As we look to these earnings this morning, the prospect of maybe boosts on net interest income on trading, but some concern around investment banking and just the broader economic outlook, how optimistic are you feeling?
Yeah, well, good morning. Thanks for having me on. I think I wouldn't say optimistic. I think everybody feels like they're kind of bracing for impact with this earnings season. I think there's a lot of, as you said, puts and takes. Traditional banking business should actually be pretty good, as you mentioned. Net interest income should be up given the rise in rates. Rates have moved higher much faster than a lot of bank executives anticipated at the beginning of the year. On the flip side, you've got housing slowing, you got investment banking slowing, and even the traditionally kind of stable wealth management business has been under fire, obviously, with the market performance. So I think there's going to be a lot of headwinds. But when you look at the valuations, JP Morgan was trading at over 2 times book at the beginning of the year, is trading 1.3 times today. So obviously multiples have compressed, expectations are low. So I think you could see, a move higher in these stocks because of that lower expectations.
Even with a yield curve that's the most inverted since the year 2000?
Yeah, I mean, that's a great point. I think that speaks to the market anticipating the Fed making a pretty big mistake here, going 100 basis points potentially at the next meeting and 75 after that.
A mistake, you say?
Yeah, well, yes. I mean, they are unfortunately, I think, looking in the rearview mirror and not out of the windshield. And out of the windshield, what you can see very clearly is growth is slowing, quite significantly, which has set the wheels in motion for inflation to slow. I mean, I know the number yesterday was very hot, but if you were to look forward 3-6 months, it's clearly going to be, I think, much lower. And so, again, the Fed's kind of looking at that backward-looking data, and they're going to be very aggressive. And the market's telling the Fed, you're making a mistake by being 25 basis points inverted currently. So, yeah, that's a headwind going forward. But I think in the near term, this hike in rates is really, you're going to see a pretty powerful earnings stream coming from traditional banking business over the next several quarters because of these higher rates.
Over the next several quarters, but it sounds to me like you're also in the camp that we'll see rates come down relatively soon. I mean, especially if we get into a recession and inflation is under control by, the middle of next year, does the Fed start to reduce?
Well, the interesting dynamic yesterday is as you saw the hikes being pulled forward, and this is in the futures market, Fed Funds futures market, as you saw the hikes being pulled forward this year, you saw actually the cuts being pulled forward next year, and the higher probabilities actually all the way going into as soon as February, the market pricing in the possibility of a potential cut. So again, it doesn't really matter what I think, is what the market thinks, and the market's anticipating rates starting to be cut in the middle of next year, and that's really not for a good reason. Inflation is going to be lower, but it's probably due to the fact that growth is going to be much slower as well. That the Fed may have to pivot and reverse course.
What else are you looking at in terms of the bank earnings? M&A has slowed down. IPOs are practically non-existent. So investment banking advice is going to be less profitable.
Yeah, I mean, again, outside of the traditional banking, loans should be decent, but investment banking is going to be challenged. Housing market's going to be challenged. I think another wild card for this quarter for a lot of the bigger banks is this, the whole CECL accounting and what the expected losses are going to be under that framework. And I think that's very hard to judge at this point. I mean, you're trying to estimate the losses of a loan over the life of the loan, which is very different than you've done in the past. That's hard to do in a perfect world. I think we all agree we live in a far from perfect world right now, so very hard to estimate what those losses are going to be and to project that on these earnings announcements.
Walter, yeah, we'll keep in mind that change in accounting rules then. Walter, you mentioned that when you look through the windshield, you see an economy that is slowing. I wonder if we're going to get clues, or where should we look for clues in the bank earnings story that will inform that view?
Yeah, I think it's really going to be on the commentary. I mean, what's kind of going to be the mood of Jamie Dimon on the call today? We heard from him beginning of June talking about an economic hurricane on the horizon. We got a very different message from Brian Moynihan at Bank of America. So I'm going to be listening very closely to what they're seeing kind of in real time versus really what the quarter they're reporting is going to say. And so that's where I think we'll get the clues. And also, how much are they reserving or expecting for credit losses? What are they seeing in the card business in terms of spending, potential delinquencies there as well?
Okay, so that's where we focus. In terms of the numbers they report, and even if this is going to be a bit backward-looking perhaps, even more so than usual, the trading businesses might do well because of the volatility we've seen in markets, but a lot of people will wonder if that's going to be repeatable, Walter. Will share prices move on trading results, or will it take other factors?
Yeah, they could. I mean, you look at the mix of business. I mean, Goldman traditionally benefits more in that scenario than, say, a Morgan Stanley would or a JP Morgan would on the trading volatility. But I think that's going to be, again, kind of look through to your point and really going to focus in on some of those other core businesses and see what the outlook for those are going forward. But again, it's this trade-off between how much of this potentially bad news on the outlook is in the stocks at the current levels, and how they react to those earnings and guidance.
Well, to that point, Walter, we have a board up on the screen right now. All of these players are down by 0.25% or more year to date. Are you adding to your positions in the likes of JP Morgan and Bank of America on this weakness?
Yeah, so we have model weights in those names, and as they have come in, we've run what we call run those to model. So we've added to them to get them up to those target weights, but we are underweight financials and banks currently. I don't see that changing in the near term right now.
Walter, thanks so much. Thanks for joining us. Walter Todd of Greenwood Capital. Coming up later in programming, we'll get reaction to the JP Morgan earnings and to that earnings call, perhaps. What will Jamie Dimon say? What will his characterization of the threats to the U.S. economy be, given his talk of hurricanes in the past? We'll get some analysis with Gerard Cassidy, RBC Capital Markets Head of U.S. Bank Equity Strategy. That's at 6:30 New York time, 11:30 here in London. This is Bloomberg.
Welcome back to Bloomberg Surveillance Early Edition. I'm Matt Miller with Kailey Leinz here in New York. Anna Edwards with us out of London. Tom Keene joins us now, co-anchor of Bloomberg Surveillance, to talk about the show ahead. And Tom, the Japanese yen at the weakest level since 1998. Janet Yellen yesterday in Asia saying we let markets take care of currencies, but that's until we don't, right?
There are no less than 20 charts I could show this morning, Matt. Markets are unraveling. There's no other way to put it. Something as obscure as Singapore dollar versus Thailand baht is extraordinary. This is the most zombie-like chart I could find. I have never seen a chart like this. This is dollar yen back before 1998 with the weaker yen, the red circle of the sweat of August of 1998. And we're getting there, which is a big deal. But what's far more important is the lethargy. Notice how the series in 1998 is jagged, it's got drift, it's got trend, it's got something the quants call Brownian motion. Now it doesn't. It looks zombie-like, lethargic. There is no life to the weakening of yen. This is absolutely extraordinary and one indication of what you see out there this morning.
And are you going to be talking about that with Margie Patel, Allspring Global Investments Senior Portfolio Manager, Tom? What else is going to be the
she's
under the
legendary,
spotlight today?
and we're going to talk to her about what do you actually do with your money. And one of the things you do is you pause and listen to what James Dimon and Mr. Gorman over at Morgan Stanley are going to say. J.P. Morgan and Morgan Stanley are living this in real time. Sonali Basak told me that the VAR, the value at risk, will be of interest, and we'll do that. Gerard Cassidy helping out.
Yeah, really looking forward to the breakdown of those results. Tom Keene, co-anchor of Bloomberg Surveillance, thank you so much. And on that point, that's what I'm watching today, U.S. bank earnings with J.P. Morgan and Morgan Stanley. Guys, it feels to me that every positive thing the banks have going on, there's also a potential negative ramification of that. You think about the prospect of higher interest rates. On the one hand, that helps on net interest income. On the other hand, does that actually slow down loan growth and things like mortgages? Then you have trading that could do really well given how volatile markets are. But what does that do to deal making, investment banking fees, considering there aren't many companies eager to come to the public markets when they're as tumultuous as this? And we've seen M&A activity slowing down. And then really that hurricane forecast from Jamie Dimon is what I'm going to be watching for on these conference calls, Matt. What do they say about the health of the consumer, the economic outlook, the risks of a recession? I'm sure markets will be clinging to each and every word from these banking executives.
Yeah, absolutely. We all will. We're also going to be watching PPI, U.S. PPI coming out at 8:30 today, and the last reading was 10.8%. The estimate for today is 10.7%. Clearly, there's a talking point that's been circulated amongst all administration officials to call this unacceptably high inflation. The question is, what can the administration do about it? And we're going to see one attempt to do something about it tomorrow when President Biden visits Mohammed bin Salman. The question is, how unacceptable is inflation as opposed to how unacceptable is it to murder and dismember a journalist? Those two things are going to have to be balanced. Anna?
Yeah, the balance of the economic and the geopolitical very much on show when it comes to that trip to the Middle East. Anne-Marie Horder bringing us updates, of course, as that trip continues. I'm watching politics a little bit closer to where I am right now, and that is in Italy. We had confirmation this hour that a confidence vote will be taking place in the Italian government. One of the partners in that government, one of the coalition partners, has said that they might abstain from this vote. And will that end up with the resignation of Prime Minister Mario Draghi, who you see in these images on our screen right now? And that could matter to markets, of course. The actual subject of debate right now is whether Five Star will back the funding of a spending bill which funds the Ukraine assistance. It funds families who are fighting higher costs. But will this result in the resignation of Draghi? And then over to you, President Mattarella. Will you accept that resignation or tell Mario Draghi to go back and try again? And Matt, I guess this matters because we've seen the ability of the Eurozone peripheral story to blow up on occasion and to distract from the tightening agenda of the ECB.
Yeah, absolutely. The question is, which way does it go, right? If there's a real problem in the Eurozone, does that lead to concerns again about a breakup, or does it lead to more of a federalization? And I think a lot of people this time are betting on the latter.
Right, yeah, forged in crisis, often said about the Eurozone. Right, that is it for Early Edition. More surveillance is ahead. Tom, John and Lisa will be taking you through response to the CPI number of yesterday. Plenty of analysis still to come on that. A lot of moving parts, as Tom was telling us earlier on. This is Bloomberg.